Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host Tim Miller. G'day, Tim. How are you?
Yeah, going pretty well, Aaron. How are you doing?
Not too bad, thank you. Well, we are going to keep on this Division 296 tax journey, and importantly, we've now seen the submissions period close last week, and we're starting to see surface a number of issues being raised from within the industry about the exposure draft and the information contained within the explanatory memorandum. So, Tim, I wanted to get your insights because you have been part of some of those ongoing discussions within the SMSF Association in particular. And now that submission is, I guess, in the public domain, we can probably talk about some of those concerns and why they are being raised as concerns. And let's start at the beginning and look at I'd almost call it cheekiness by Treasury in terms of the way in which an individual's TSB will be measured for the tax, where once we get past the introduction of year one of these measures, we're going to be looking at a TSB at the higher of even the start of the year or the closing balance at the end of the year.
Yeah, look, and if you recall, Aaron, under the previous measure, so when it was first touted, the whole concept of Div 296 was based on a movement in total super balance from start of year to end of year, and of course that threw up a whole lot of issues, unrealised capital gains being the most significant one, and so not just the SMSF sector, but other parts of the industry as well, sort of indicated that was really a no go, and you needed to revisit that. And to the government's credit, I'll say that begrudgingly, they did look at changing the formula for the earnings piece. But what they've then landed on is this scenario where we are used to this being calculated based on your total super balance at the end of the financial year. But they've thrown in this additional measure to say it will be the highest of your total super balances from either immediately before the start of the financial year, so end of the previous year's financial balance, or the end of the year in question. So it's effectively a bit of a case of, have your cake and eat it too, in the sense of we're just
Mm.
going to say, at any point in time, were you over $3 million? If so, we're going to tax you, is kind of the feel that it's got. And we think that there's, that's a misrepresentation of what this legislation was introduced for, because it doesn't factor in a lot of key issues such as, weird spikes. There might
Yep.
be an event that occurs that spikes your balance at the beginning of the year or the end of the year, and then it drops back down almost immediately afterwards. Well, this could capture that one person who is inevitably only over $3 million for a day,
Mm.
and then subsequently gets hit from an earnings point of view based on that. And so, um, not only that, but a number of other elements that we'll work on soon. But yeah, this whole total super balance change up to being recorded twice a year, or being measured twice a year, other than the first year, as you pointed out, is certainly what we consider a problem.
Yeah, and I think one of the ones that got highlighted in the submission from the SMSF Association was, you look at things like First Guardian. So you might have a valuation at the end of a particular year, which therefore would be reflective of the value at the start of the following year. And in essence, the value of that particular asset is such that that individual's now moved below, but they're ultimately going to get a double hit under those rules when in essence they shouldn't. And from the first iteration of these Div 296 tax rules, there was adjustments around things like withdrawals, but there
Yep.
doesn't seem to be here. Obviously, there might be a push towards revisiting this or seeing how the regulations might deal with some of these matters, or whether the regulator themselves might be able to look at some of these instances themselves with some sort of powers. But yeah, straight away, it feels like they're trying to capture those that will want to withdraw money out to try and avoid it. But by doing so, they're actually, by closing one door, they're actually blowing a whole heap of windows out the back at the same time.
Yeah, and look, what we don't want is an industry where people are trying to manipulate, to use a term, the total
Yep.
super balance via the manual adjustment. I mean, the manual adjustment does serve a purpose for exit costs and a few other things if need be, but you don't want people to start mucking around to go back and change total super balances because of a singular event. You'd rather those particular events or whatever, or the concept be driven on end of year or start of year. Like it's got to be one or the other. Most of us obviously lean towards that end of year situation, but the idea that you're basing it on an either or approach, whereas before you used to replace the opening and closing balance with 3 million to negate paying too much tax. So under the old measure, they effectively were saying, no, we don't want you to pay in on any earnings above that. But now they're going, well, we want you to be above it.
Yeah, and the interesting thing now is becoming, because we've seen it with the gnarly stuff as well, is these, in inverted commas, integrity measures that are coming in, which suggests that there's not a lot of trust in the behaviour that trustees and members are undertaking within this SMSF sector to try and, arguably, are they saying that they feel that there'll be too much abuse on this? It's quite interesting. We don't know where this will land, but it's certainly something that we've seen in a number of submissions. Let's move on to another topic, and that is the topic of death, because again, in the context of the original rules, death and Div 296 was only relevant in one situation, and that was if you died on the 30th of June. Whereas now, there is much more context around how Div 296's liability will arise in the year in which a member passes away, and potentially beyond.
Yeah, and that is that, that whole dying pre-30 June used to remove the Div 296 liability. That's been removed from the legislation, other than year one. So again, year one, there is this carve out for dying in the first year, but beyond that, you will be assessed. And of course, so it has a multitude of elements associated with that. The first one, if we deal firstly in isolation with the deceased person, right? So forget what impact it might have on their spouse or something like that if there is a spouse there. But if we assume, as is the case, that a death benefit has to be paid out of the super fund, right? It could be paid to one beneficiary, right? And then the assets of the estate might be payable to other beneficiaries. People do balancing between their beneficiaries. Yep. However, under the way, and you and I went through this with a fine tooth comb with who will be liable for the tax, it will be the estate that will be liable because that's the way that I think it's the Tax Administration Act or whatever is written in this regard. Now, what that means is somebody who didn't benefit from the superannuation money may actually be disadvantaged by the tax liability. As one measure. The other thing is the estate might have been distributed, and so then there are no assets within the estate to pay out the tax as well. And so, just the inclusion of deceased members' balances to be liable for Div 296 seems to go against the grain of what it was brought in for in the first place, which is about money in super. This money's coming out of super in this instance, and of course, the flow on for that is that if you've got that money going from one member to the other member, so in the form of a reversionary pension or potentially as a new death benefit income stream, what you and I had shown on multiple examples previously was that there was effectively a 1 year deferral for reversionary pensions and a 2 year deferral for death benefit income streams, or potential for 2 year, based on the total super balance and the timings of the pluses and the minuses.
Great.
Whereas this will bring forward, in theory, for reversionary pensions, this brings forward the liability. Not only will the deceased have earnings for part of the year if they're over 3 million, but if their balance then goes to the spouse, then there will be an attribution of the earnings to that spouse as well. And so, yes, conceivably the actuarial certificate, ensures that no one pays too much. But it also means that somebody's paying more than they would have under the old measure. Is that right?
Yeah, well, the other interesting thing there with the actuarial requirement is it kind of felt like it was just a mandatory function across all. It didn't matter who or what structure the fund was. If you had in-scope members, in essence, the actuary was there to determine what that proportionate method looked like. Now, let's hope we don't end up in the same situation as we did with disregarded small fund assets there last time. And that has been something that has quite clearly been pushed back, because if we've got a single member fund and that one member has $8 million in there, well, I think we're pretty comfortable that we don't need the actuary to give us that 100% exempt calculation of attributed earnings.
No, that's right. We know who the in-scope member is, and we know how much of the earnings belongs to them. And so it's one of those areas that even talking to actuaries about it, they go, well, what's the point? We don't need to to do that in this situation. So again, that whole calculation, and of course, we also honed in on the word you may need an actuarial certificate, in the part of the regulation. So does that mean self-managed super funds are going to be given choice? Highly unlikely.
Unlikely, yeah.
But we almost need to see those regulations before we can comment further. So it's very hard to comment on consultation without all the materials.
Yeah, absolutely. And I think the last one that would just be worth talking about today, there are more than this, and we'll obviously keep talking about this as a topic over the coming episodes as well. But it was really around this CGT adjustment and the mechanics of this, because there are decisions that need to be made for funds, and this actually expands even beyond those that have members that are in scope, and it's potentially those that might be in scope in the future. So can I get you to elaborate around, obviously this is an ability to make an election to have a CGT adjustment done for Division 296 tax purposes only, but what are some of the concerns that have been flagged here with this proposed CGT adjustment?
Yeah, look, I guess the main one is if we look at our most recent version of CGT elections, it was 2007 or pre-2017 with the introduction of the transfer balance cap. And that was effectively an asset by asset choice that you could make with regards to what you did. Whereas this is an all in, all out approach with the reset of cost base at 30 June. So obviously good that it recognises that they don't want to tax the earnings of assets prior to that, or the gains that were attributable prior to 30 June 2026. But the idea that it had to be all assets in, right, is kind of clunky, and also it's got nothing to do with the super fund, right? So it's actually not a CGT liability from a fund point of view. It's a separate bit of accounting, and so that was kind of messy. And so what I've seen and what I've heard from various discussions is we've already had this CGT stuff raised when CGT ultimately came in 1988, and at that point in time they said, well, look, you either use the cost base or the value at June 88 or whatever the date was back then. And so looking at saying, well, what's the highest, the cost base of the asset or the cost base of the asset at 30 June 2026, it means there's no additional cost, no additional admin required, because you've got all that information recorded, and you just work off the highest cost base scenario.
Yeah, and try and remove any need for an election, which again is an administrative function that some people might take advantage of, others might miss out on that opportunity. And I think I made the comment at the very beginning of this topic was the fact that there will be some people that it's actually going to be worthwhile doing for in the context of those that might pass away and then subsequently have those benefits attributed to another dependent, and that money stays in the fund. So getting that stuff right should be simpler than potentially what has been proposed by government. But again, we're at exposure draft now. They're running at a pretty rapid rate. We know the consultation has been tight, including Christmas and New Year. There is an expectation that they want to sort of introduce this early in February into Parliament. I think it would be fair to say, Tim, that the submissions that have been made, in particular with the SMSF Association, have really focused on the things where you'll get your most bang for buck, because in all likelihood, Treasury would be probably pretty set in its ways by virtue of having issued that exposure draft when they did.
Yeah, look, and we sat down in our roundtable with the SMSF Association, and there's a lot of issues that we said we could raise, but we're not going to die in the ditch for them. So you've got to go after the big ticket items as such to try and get as fair an outcome as possible, rather than to focus on like the small intricacies that will clearly just not be addressed, and you'll just have to deal with on a case by case scenario.
Yeah, absolutely. Well, thank you once again. There's plenty to keep us busy in this space. We're working on a number of things, including Division 296 Tax Hub to go alongside our legacy pension hub, just to name one thing that we're doing in this space, obviously, in addition to our upcoming SMSF days as well. So, Tim, thank you once again.
Always a pleasure.
We look forward to seeing you next week. Take care. Bye for now.
Bye.